This video is actually a collection of a series of episodes of my basic accounting series. So this is made for those who want to watch a whole subject taught normally in one whole semester in just one video. Contrary to what you might think, this is not a summary. This is a comprehensive lecture which is made assuming that you have zero knowledge about accounting. But if you want to see the segmented version, the links are on the description below. Now, if you're ready to learn or review the basics again, then let's get started.
Hello and welcome to my channel. In today's video, we are going to answer the question, who are the accountants and what do they do? This again, Gletzmar B. Igcasama CPA. This lecture is made to let you, the accounting students, appreciate the profession and to let you know more about the accountant's role in the society. Not a lot of people know what we do specifically. Well, not as much as other professions. Like for example, people have a clear understanding of the role of engineers, lawyers, doctors or nurses or media people than accountants. So what do people think? The first one is we are good at math. Like they really think that we are really good at complicated math problems or formulas, or all of us can compute mentally. Well, as per experience, when I was eating in a carinderia and the cashier asked me to compute the total amount that I and my friends should pay, I used calculator. Another is that accountants work in a bank. Another misconception is when we become a CPA, we just need to affix our signature to papers and then we will be paid big money. Let me emphasize that this video is meant to clear these misconceptions if you want to, and to describe the work of an accountant. And to do that, let us first visit the accounting definitions provided by different organizations. The first one is from Accounting Standards Council. It states that accounting is a service activity. Its function is to provide quantitative information, so it's related to numbers, primarily financial in nature, meaning these numbers are monetary in nature, about economic entities that is intended to be useful in making economic decisions. The other definitions are more technical in nature, so in order to prepare, we need to elaborate this definition some more. So, the service related to quantitative information, primarily financial in nature, is simply the preparation of the financial statements. But where do the financial statements come from? Of course, it comes from business transactions. For example, purchase or sale of items. You just have to record and summarize those transactions and then you have the financial statements. However, the role of the accountants does not end there. The numbers in the financial statements are useless unless financial information can be extracted from them by analyzing the financial statements. The information is then communicated to interested parties known as the users of information. So who are these users of financial information? The users of the financial statements are the following. We have the government, we have the employees, customers, lenders, investors, public, and suppliers. If you wanted to memorize them, you can use the acronym provided, which is GCLIPS. As you can see, there are some of them whose fonts are colored red. Those are the primary users of information, namely the lenders, investors, and the suppliers. Each of these parties has their own reasons why they're interested with the FS information of the entities. For example, the government is interested in business organizations because of taxes and their effect in the country's economy, especially if we are talking about large companies. Lenders and suppliers are interested in the entity's capacity to pay their debts. Investors or owners want to know if their investments are paying off. Employees are concerned on the stability of the company that they are working with because all of the employees wanted to have stable jobs. The public and the customers need to know the financial status of entities, especially those who are considered public entities or large companies who have public responsibility because it might affect their decisions. To make it clearer, for example, the public will want to know if the banks or insurance companies that they have invested in or trying to invest in is still financially healthy or not. So that's it for the first definition. Let's go to the second definition by the American Accounting Association, which is the oldest definition of the four definitions that we are going to tackle. It states that accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of the information. So this definition is similar to the first one except for the words written in bold format, which is identifying and measuring. So let's discuss the identification first. On the identification phase, we just have to select the accountable transactions. That means not all of the business transactions are accountable. To be accounted, the transaction must meet these two. Accountable transactions are those transactions that can be measured in monetary terms and are those that affect the assets, liabilities, and equity. I know you have already an idea with the concepts of assets, liabilities, and equity, but still I will still elaborate in simple terms. Assets are the resources controlled by the entity. Ownership is not necessary in order to claim a resource as an asset like machineries, building, and any other assets as long as you control the benefits related to the asset. Liabilities are generally debts of the entity from third parties, an example of which is the loans payable from the bank. The equity can be described as the amount due to the owners or investors because they invested resources in the entity. Actually, on the question, what are the transactions that affect the equity account, we have investment from owners, we have withdrawal by owners for personal use, we have revenues earned from customers, and expenses for doing business. And if you are to consider investment minus personal withdrawals of the proprietors plus revenues or sales to customers minus expenses equals the amount due to the owners. In simple terms, if liabilities are the debts of the entity to third parties, the equity is the debt of the entity to the owners. I hope that's clear. Now let's go back to the accountable versus non-accountable business transactions. If the transaction cannot be measured in monetary terms and it cannot affect the amount in the assets, liabilities, and equity, they are considered non-accountable. Examples of which are the hiring of employees and the signing of a contract with your clients or suppliers. So that's it for identification. Let us now go to measurement. If you have already identified the accountable transactions, you need to assign peso amounts to those transactions before recording it. However, there are a lot of valuations in accounting that you will meet when you study further, an example of which is the face value. If you are going to encounter cash-related transactions, those should be measured at face value. Another is, if the transaction is related to acquiring an item or an asset, the transaction should be measured at acquisition cost or historical value, which is the actual amount paid to acquire an item. We also have the fair market value, which is the value that the sellers and the buyer's mind meet. Actually, it is the price that the seller is willing to sell and the buyer is willing to buy. Some items must be valued at net realizable value. For example, your accounts receivable. When the business entity already rendered services or delivered the products to the customers and the customers did not pay yet, you are going to recognize receivables. Let us say, for example, your accounts receivable is 100,000 from your customers. Do not expect that the full 100,000 will be collected. A portion of the amount should be recognized as doubtful. Let's say, for example, the allowance for doubtful accounts is 9,000. The net realizable value that you are going to consider is only 91,000. And of course, there are a lot more. The point is, measuring phase is not just assigning peso amounts to transactions, but also assigning the proper valuation to the accountable transactions. So, let's go now to the next definition, which is from American Institute of Certified Public Accountants. It states that accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money transactions and events which are at least part of a financial character and interpreting the results thereof. Actually, the most important terms in this definition are the words recording, classifying, summarizing, and interpreting because all other L's are similar with other definitions. Recording, summarizing, and interpreting are also mentioned a while ago, so we are going to focus only on the word classification. Classification of transactions comes after the recording of accountable transactions. It means you need to group the similar transactions, and an example is, even if the company made sales to different customers in a day, let us say for example, you catered 10 customers who paid in cash 50,000 each. You need to group it and record sales for a total of 500,000 in the ledger. But more will be discussed about this topic, especially about the ledger in the next videos. So that's classification. So if you're going to summarize the three definitions of accounting in one, we can say that the accounting is a service activity which starts with the consideration of business transactions by identifying which ones are accountable. After that, the accountable transactions will be properly measured and valued, and then those transactions will be recorded and classified and summarized to form financial statements. The financial statements will then be analyzed to extract financial information, and this information will be passed to the users of financial information to aid them in their decision making. So who are these users again? So the users of FS are the government, the employees, the customers, the lenders, the investors, the public, and the suppliers. I hope you still follow, but we are not yet through. We still have one short accounting definition to consider yet, and that is, accounting is the language of business. Entities do not have a physical form like us humans. We humans can easily communicate and answer questions like, what do we need? Or are we experiencing pains? Or are we sick? Or are we dying? Businesses cannot do that directly to their users. That is why their needs and their problems are channeled and captured by us accountants first. The accountants will then communicate these business problems to the users of information, plus its suggested solution on the business problems, as well as the financial condition of the entity and its financial performance. So that's it for the fourth definition. So based on the definitions we discussed earlier, let us answer the questions: who are the accountants and what is the nature of our work? So you can answer it with, an accountant is the one who identifies, measures, records, classifies, and summarizes accountable transactions to produce financial statements. He or she is also the one who extracts and communicates FS information to users of FS to help them make their decisions. I do not know if they will understand, but the most important thing is that you do. Or you can answer them shortly: an accountant is the interpreter of the language of business. So that's it for this video. You are welcome to play and replay this video until you are satisfied. If this helped, please click subscribe and hit the notification bell to be updated on my next episodes. You can also share this to other accounting students. Hello and welcome again to my channel. For those who are new, I am Gletzmar Igcasama, your Filipino accounting teacher. Before you watch this video lecture, please watch the previous video so that your learning can be maximized. The link is on the description below. So for those who have already watched it, let's continue with this video. This video aims to let you fully understand the identification of transactions as well as analysis of transactions, which is the step 1 in the accounting cycle. This lecture contains the following: the concept of identification of transactions, and we are also going to discuss about the significance of the accounting equation A is equal to L plus E. We are also going to enumerate the types of transactions that you might encounter as well as their effects on the assets, liabilities, plus equity. So we are also going to talk about the concepts of accrual, revenue expenditure versus capital expenditure, and depreciation. And lastly, we're gonna have some illustrative problem related to transaction analysis and of course with solution. So now let's start with the identification of transactions as well as the equation A is equal to L+E. As I have told you in the past, not all the business transactions are accountable. Accountable transactions are those that can be measured in monetary amounts, that's the first characteristic, and those that can affect the A is equal to L+C amounts. This is the second characteristic. That is why transactions like mere hiring of employees and signing of contracts with suppliers or clients are considered unaccountable. So let's go to A is equal to L+C and let's go back to the simple definitions of assets, liabilities, and equity. Assets are resources controlled by the entity. The entity do not need to own such assets as long as their benefits are controlled by the entity. To make it clear, let us have examples. We have cash, machinery, land, supplies, and many others. While liabilities are the amounts owed by the entity to the third parties, like for example, loans from a bank or if the entity purchased something on credit or on account. And if liabilities are owed to third parties, the equity is the amounts owed by the entity to its parents or owners. The equity is composed of, let's start with the increases. It will increase if there are investment from owners. It will also increase if there are revenues earned from customers. How about decreases? It will decrease if there are withdrawals by the owners for personal use and expenses for doing business. Sir, some says that equity is a residual account. What does it mean? Well, in case the business stops its operations, assets are distributed first to third-party creditors and the balance will go to the owners or the investors. So, simply stated, assets minus liability, we have the equity. So that's why it's called the residual amount. Sir, you said that equity is somewhat like the liability of the entity to its owners. We understand that the entity is really liable for the owner's investments, less of course their personal withdrawals. But why are the revenues and expenses included in the equity amount? Since the owners are the ones who started the business and assumed all the risk, then all the benefits like revenues from customers, less business expenses must be given to them. However, if the business expenses exceed revenues, then they are the ones who will also suffer. Sir, but what is really the meaning of A is equal to L+E? Why is this equation very important? Guys, since the businesses have no physical body like us, think of that equation as the business itself. Sir, we do not agree because we can see and touch business establishments. Actually guys, those are just the assets of the entities, like buildings owned by the entities. Let's say for example, if you own a house, that doesn't mean you are your house, right? So if that is clear, the next is, think that the accountable transactions changes the business. These accountable transactions are like people's experiences that changes us. So how about unaccountable transactions? This can be compared to our small unimportant experiences that don't even matter. I hope that's clear. Please take note that on the next topics, I would like you to assume the shoes of the entity or think as if you are the business entity. Because as an accountant, you need to analyze business transactions as if it is happening to you. So we are now on the topic 3, 4, and 5. Topic 3 is all about the types of transactions and its effect to A is equal to L+E. But remember, you need to assume as if you are the business and the transactions are happening to you. The number 4 topic is all about the accrual concept, and we are going also to discuss the topic 5, which is capital expenditure versus revenue expenditure. So let's go now to the types of the transactions and how it will affect the assets, liabilities, and the capital. But before we do that, here are some important notes. The first one is, each transaction has at least two effects on the A is equal to L plus E. That means, if one asset increases or decreases, there should be at least another asset or liability or equity account that will also be affected. And number two, whatever transactions are considered, the equation A is equals to L plus E will always be true. So okay, let's start with the transactions already mentioned in the previous slide. Let's start with the investment from the owners. If we have this transaction, I've said earlier that this type of transaction will increase the equity account. But not only the equity or the capital account is increased, but also the assets of our entity. That is the meaning of this note. Each transaction has at least two effects in the A is equal to L plus E. Another is we have revenues from customers. If we receive revenues, not only the capital account will increase, but our assets will also be added. Example is, we increase our cash if the customers avail for our services or our products. But take note of this. Even if the customers do not pay yet, so long as the services or products have already been delivered, we still increase our capital because of revenues, and we increase the assets not by way of cash but by receivables. Why is it so? It is because we follow the accrual concept. And the accrual concept states that revenues are recognized when earned. So that happens when goods and services are already given to the customer and not when collected. In simple terms, unpaid services or products delivered to the customers are still recorded as revenues and at the same time as receivables. Technically, these revenues earned but uncollected are known as the accrued revenues. Another important twist is that you cannot expect that 100% of your receivables can be collected. There might be portions of it that are considered doubtful. So, if we have this doubtful, you need to deduct it with the capital account because they are considered as bad debt expense. Let's say for example, you have a total of 100,000 worth of receivables and you suspect that 10% of it will be uncollectible. So you should deduct 10,000, which is the 10% of your receivables. And you should also deduct your assets as allowance for doubtful accounts. What is this allowance for doubtful accounts? This is a contra receivable account, which means that if you have this, you should deduct it from your receivables to get what do we call the net realizable value of your receivables. Next is we have withdrawal by owners. If owners withdraw money for personal reasons, then the capital will be deducted by such amount and of course the total assets. We also have expenses. But before we go to the effect on the assets, liabilities, capital or equity, let me clarify something. The expenses that we are talking about are considered as revenue expenditures. What are these? These are expenses for items whose benefits are already consumed by the entity. For example is when you pay for water bill issued by water districts or suppliers for the water you have already consumed this month. So how do we differentiate it from the capital expenditures? Capital expenditures are expenses for items whose benefits are yet to be consumed by the entity in the future. Example is when you pay for, let's say, machinery, where you are still to enjoy its benefits or usage in the future. So let's go back to expenses. When we have expenses, our equity or capital account will decrease and also is our assets. That is if we paid for it in cash immediately. But remember this, even if we haven't paid yet for the services or the benefits of the items we already consumed, expenses will still be recognized. That's why the capital will be decreased. However, instead of deducting the assets just like we did here, we are going to add the liabilities because it has become our debt payable in the future from the moment we enjoy the benefits of the services or the products. Why is it so? It is because of the accrual concept again, which additionally states that expenses are recognized when incurred or when the products or the services are already consumed by our entity and not when paid. By the way, These unpaid expenses for services or products are technically known as accrued expenses. Next is we have advance collections from customers. So if we have this, then logically, of course, our assets will increase, specifically the cash. But we are not still going to increase the equity account because they are not yet considered as revenues, because we have not yet delivered services or products to the customers. Let's go back to the accrual concept. It said that revenues are recognized or recorded when earned and not when collected. So sir, if we do not increase the equity or the revenues, what account will we increase, sir? The answer is the liabilities. You are already liable or obligated to deliver goods or services from the moment you accepted the advance payment. And by the way, these advance collections are technically known as deferred revenues, the opposite of accrued revenues. Diba? In the past, I said in the accrued revenues, the customers are late in paying. But in deferred revenues, it's not the case. The customer pays in advance. But in the moment that you have already earned those payments, you're just going to deduct the liabilities and you're going to add the capital account because these are already considered as revenues. We also have our own advance payments to others. Let's say for example, advance payment for rent or prepaid insurance and etc. When we pay in advance, then logically, we lose an asset, and that asset is specifically the cash. But we do not treat the payment as expenses yet because we did not consume any benefit yet. So instead, we increase another type of asset known as the prepayments or deferred expense. If you translate deferred expenses, then in simple terms, we can call this not yet expenses. It is the perfect opposite of accrued expenses. If accrued expenses are expenses incurred but not yet paid, deferred expenses are not yet incurred but it is already paid in advance. If you analyze deeper, it's as if there is no effect in the total assets balance because although one asset is sacrificed, which is the cash, another was increased in the form of deferred expenses. I hope that's clear. But the moment you have consumed the benefit already, then you are going to deduct your assets and you are also going to deduct the capital account because the advance payments are already considered as expenses already. We can also incur debt like loans from a bank or when you are going to purchase something but you are to pay later pa. Upon incurring such debt, the liabilities will be increased. But of course, the assets will also increase. And if those loans or liabilities are paid back, then the effects are opposite. The liabilities will decrease, and so is the assets. The only twist here is if there are interest expenses. So interest expenses are considered as any other expenses. So if there are interest expense, the capital will be decreased, and of course the assets will be decreased also if it is paid immediately. However, if those expenses are not yet paid immediately, then you're going to recognize expenses. So you're going to deduct the capital account, but you're going to recognize liabilities because now you have an interest payable already. We can also exchange an asset with another asset. So of course, the assets will increase, but there is also another type of asset that will decrease. So if you're going to analyze this as if there is no effect on the total assets. So an example of which is the cash purchase of machinery where you sacrifice the cash, however you are going to acquire another type of asset which is the machinery. The only twist here is when you pay partial. For example, this illustration where office equipment was purchased at 100,000, however the down payment given is only 30,000. The rest is payable in 10 days. Of course, the assets will increase by 100,000 in form of office equipment. However, the asset will also decrease because of the down payment of 30,000. So in effect or in summary, the assets increase by only 70,000 and the liabilities will increase by 70,000 because again, out of 100,000, 30,000 was only paid. The last transaction that we're going to talk about is the depreciation. However, before I talk about the concept of this one, let me tell you first that depreciation is an expense. So if this is an expense, you're going to deduct the capital account because expense transactions are a decrease on the capital account. And of course, you are going to decrease the assets. But I know you need to know about depreciation. So let's go to depreciation. The depreciation is related to depreciable assets. What are these depreciable assets? These are long-term assets, or simply stated, these are assets whose useful lives are more than 1 year, or they can be used for more than 1 year. Not only that, these long-term assets must also be affected by physical wear and tear due to passage of time or continuous usage. So, long-term assets like land are not subject to depreciation. So what is depreciation? It is a deduction of the value of the depreciable assets per period due to physical wear and tear. And how can it be computed? Let's have an illustration to do just that. So equipment has a value of 100,000 that has a useful life of 5 years and a salvage value of 5,000. So no need to explain about the useful life because it is self-explanatory. But we need to talk about the salvage value, or what do we call the scrap value sometimes. The scrap value is the amount that can be realized if the item is sold to, for example, junk shops after the asset has been fully utilized. To compute for the depreciation expense, step 1 is to get the depreciable amount. So we have the historical cost of 100,000, but since the problem provided for a salvage value, then you deduct that 5,000 and then you are going to have the depreciable amount of 95,000. Sir, what is this depreciable amount? The depreciable amount is the total decline in the value if the asset becomes useless. So if you analyze the problem, then the conclusion is even after the equipment has been fully utilized, it still has a value of 5,000. So the maximum decrease in its value during its useful life of 5 years is only 95,000. The next step is to divide depreciable amount with the useful life, which is 95,000 divided by 5 years equals 19,000. So that is the depreciation, or what do we call decrease in value per year of the equipment because of physical wear and tear. To understand it further, let's have a timeline analysis of value and depreciation charge per year on the asset. So as you can see, you start with 100,000 and then minus 19,000, you have 81,000, and then another 19,000 is deducted, so we have 62,000, and at the end of year 3 another 19,000 was deducted, so we have 43,000. Another 19 will still be deducted at the end of year 4, so we have 24,000, and lastly the last 19,000 is deducted, so we have still 5,000 value of the equipment even after the useful life of 5 years. So that's it for depreciation. But let me remind you again, if you wanted to get the depreciation expense under straight line method of depreciation, then you need to deduct the salvage value with the cost before dividing it with the useful life. And now, let's go back to the previous slide. So, we are back on this slide in order to tell you one thing, and that is, these transactions related to these arrows with orange colors are to be recognized usually at year end. For example, these doubtful accounts are to be estimated usually at the end of the year. Of course, if there are revenues that are already earned but the customers did not pay yet, or accrued revenues, those are to be traced at the end of the year, as well as your accrued expenses. And if you have earned a portion of the advance collections from the customers, those are to be recorded at the end of the year. And in case of your advance payments, of course, the portion consumed are recognized at the end of the year also, as well as the depreciation. So here we are in the last portion of our video lecture. So let's go to the comprehensive illustration. On November 1, 20x2, GAAP, or Gletzmar Accounting and Auditing Practice, has the following transactions during the months of November and December. Here are the transactions for the past 2 months. So in here, we have transactions A to J and adjusting transactions on 1 to 6. So our job is to know their effects on the accounting equation assets equals liabilities plus capital. In transaction A, the owner invested 100,000 in the business. So of course, the capital account will increase as well as the assets involved. So we have a balance A is equal to L+C. However, this transaction B, where the business paid for business permits and licenses of 2,300, it's a typical example of revenue expenditure, and this type of expenses decreases the capital and of course the assets because we have already paid for these business permits and licenses. While on letter C, the rent for 5 months, which is 3,000 per month, so all in all, we have to consider 15,000, was paid in advance at the beginning of November. This is a deferred expense because it is an advance payment where we did not consume the benefit yet. So here, the cash will be decreased by 15,000. However, the deferred expense or prepayments, or in this case, it is better to call it prepaid rent, is also increased by 15,000. Remember, deferred expenses are also considered as assets, so they offset each other. That is why, in this transaction, there will be no effect on the total assets. In letter D, supplies were purchased for 20,000. However, 10,000 was paid in cash and the rest were paid after 2 months. In here, although the assets in the form of supplies increased by 20,000, another type of asset was sacrificed, which is cash of 10,000. So in effect, the net effect on the total assets is only an increase of 10,000. And of course, 10,000 liabilities will emerge because of the transaction. In letter E, office equipment was purchased for 30,000. There is no effect in the total assets because even if we have received a new equipment, we lost cash also. So there is no effect. We are in effect just exchanging an asset with another asset. So letter F is another type of expense. So we just need to deduct the capital as well as the assets also. As well as letter G is also type of an expense, utilities for water, electricity, and etc. So we're just still going to deduct the capital 19,750 and the assets also of 19,750. In letter H, 3 clients paid professional fees for 5 months in advance at the beginning of December 20x2 or the second month in our illustration, worth 80,000. This advance payment is considered as deferred revenue, right? Where we receive cash first before we do some service or deliver products. So what do we do with this? Of course, we're going to increase the assets of 80,000, but we are also going to increase our liability account. We have 80,000 also. Now, we are not required to pay cash in the future to settle this liability, but we must provide in the future some goods or services to these clients. On letter I, other clients paid 40,000 for services already rendered. So logically, we just need to add 40,000 to our total assets and also add the same with the capital because they're already considered as revenues because services are already rendered. And lastly, letter J, the owner withdrew cash 25,000 for personal purposes. So withdrawals, according to our discussion a while ago, by the owners are deducted from the capital account. And that you also deduct the total assets on the amount of the withdrawal. So let's go now to the transactions for adjustment. Transaction number 1 is directly related to transaction C above. It states that the advance payments for 2 months was already used. So since the monthly rent on letter C is 3,000 per month, then you multiply it by 2 months, then we have 6,000. So you need to deduct your assets with 6,000, specifically the prepaid rent account, and then you're gonna deduct also the capital because they are already considered as expenses. While transaction number 2 is related to transaction D above. The supplies purchased was worth 20,000 according to here. However, in the transaction number 2, only 3,500 worth of supplies remained. So, we can conclude that the difference of 16,500 was already consumed. So, you need to decrease the supplies account, which is an asset account, worth 16,500, and of course there is also a decrease on the capital account because of the supplies expense. Transaction number 3 is an additional information about transaction letter E. It says that the 30,000 equipment has a salvage value of 500 and a useful life of 5 years. So in here, we need to compute the depreciation expense by first computing the depreciable amount. So we have 30,000, the historical cost, and the salvage value of 500. So we have a depreciable amount or depreciable value of 29,500. And then you divide it by the number of years of useful life. So we will have a depreciation per year of 5,900. But remember, we're only talking about 2 months, November and December. So you need to multiply this one with a fraction, which is 2 months over 12 months, and you will have 983.33. And since depreciation is a type of expense, the capital account will be decreased, and also the assets will also be decreased. Transaction number 4 is an unpaid expense or accrued expense. Such expense, if you can still remember, shall still be recognized. Therefore, you should deduct the amount 3,000 from the capital. And of course, since it is still unpaid, you recognize it also as a liability. Transaction number 5 is an accrued revenue, where the entity has already delivered products or services, but the customer is late on its payment. It will still be recognized as revenue, so you add the capital account with 5,000 and of course the assets 5,000, but not in the form of cash. It is in the form of receivables. Transaction number 6 is directly related to transaction H, where there is an advance payment from customers worth 80,000. It has been recognized earlier as a liability. Now, transaction 6 states that 1 month out of 5 months have already been earned. So we have 80,000 divided by 5, or you multiply it times 1 over 5, then you're gonna get 16,000. So what will happen? So your liabilities will be decreased because you have already earned the 16,000, and of course, you're going to recognize the 16,000 as revenues already. So that's it for our analysis. The next step is to add all the effects of the transaction in the assets, liabilities, and equity. And you're gonna get in the assets 134,466.67. On the liabilities, you will have 77,000 and 57,466.67 for equity. If you add the liabilities and equity, the sum is really equal to assets, which is 134,466.67. This is what do we call balanced. So to end this, please always remember that each accountable transaction has at least 2 effects on the A is equal to L+E or L+C. And whatever the transactions are considered, the A should always be equal to liabilities plus equity or capital. So that's the end of our video. If it helped, please click like and subscribe and share this to other students. Also, please click the notification bell to be updated on my latest videos. This is again Gletzmar Igcasama, the fact, the Filipino accounting teacher. We are now on the step 2 of the accounting cycle, which is the recording of transactions, or what others call the journalizing. Since our goal is to record the transaction, here is a sample transaction extracted from our comprehensive problem in the last episode. This is transaction letter D in that video, and this transaction is supplies were purchased for 20,000, 10,000 was paid in cash, and the rest were paid after 2 months, which is in the past video is already after the reporting period. Here's how you record this transaction. So you can read this as debit supplies 20,000 and then credit accounts payable of 10,000 and then another credit cash 10,000. As you can see, the credits are written not in line with the debit. There's a little bit of indentation in both these credit account titles and these amounts. But sir, we don't understand what is debit and credit. What is that? So before we continue, let's answer that question first. So what is debit and credit? But before we answer that, let's visit again the accounting equation, which is assets equals liabilities plus capital or equity, and assign either debit or credit to assets, liabilities, and capital. But first, let's separate assets from the liabilities and the capital or equity and assign debit on the assets and credit on the liabilities and the capital or equity. Sir, okay, we have familiarized already the assignments. However, what is really the meaning of debit and what is the meaning of credit? Okay, let's make it simpler. You all know that each profession has its own technical terms, right? These terms can only be understood by the members of the same profession. Admit it or not, sometimes when we hear a lawyer or doctor talk, we barely understand what they're talking about. This debit and credit are also like these technical terms that only we who are studying accounting and business-related courses understand. So what's the use of these assignments? In the past video, I told you that assets, liabilities, and equity can increase or decrease. But instead of saying the assets increased, we say the assets are debited. And of course, instead of saying the liabilities and the capital increased, we say that it is credited. So meaning, these assignments, debit for assets and credit for liabilities and capital, are substitute for the word increase. And of course, in the opposite, instead of saying the assets is decreased, we can say that the assets is credited. And of course, if the liabilities and equity decreases, we can say it is debited. So in the statement, liabilities is blank and the assets is blank because of the payment of the loan. When we incorporate what we have learned in the past video, we can say that the liabilities is decreased and the assets is decreased because of the payment of the loan. But if we are going to incorporate what we have learned so far in this video lecture, we can say that the liabilities is debited and the assets is credited because of the payment of the loan. So I hope you got it. And since I always emphasize that the capital can be increased by both the investment from the owners and revenues from customers, so let's assign credit to them. The same with the normal balance of the capital account. I also told you that the capital can be decreased by the withdrawal by the owners and expenses of the business. So since it deducts the capital account, let's assign to them debit. So that's it for the normal balances. But in order to make the familiarization easier, you can remember the word dealer. D stands for drawing or withdrawal by the owners, E is for expenses, and A is for assets. You remember these first three, their normal balance is debit. And of course, the last three, we have L for liability, E for equity, and R for revenues. Their normal balance is also credit. So that's the meaning of debit and credit. But before we end this slide, I will introduce you to the elements of the financial statements, which are A.L.E. That is the acronym. Actually, this A.L.E. is just coming from here. So actually, A stands for assets, L stands for liabilities, E stands for equity, R stands for revenue, and E is for the expenses. As you observe, withdrawal is not here, as well as the investment from the owners is not here. It is because they are still under the capital account. So why are the revenues and expenses separated from the capital, sir? It is just temporarily separated, guys, because they will be emphasized in the financial statement known as the income statement. But at the end of the year, or at the end of the accounting period, the revenue less expenses will be merged again to the capital account and will be reduced to zero. That is why this revenue and expense account are called temporary accounts. Sometimes they are called the income statement accounts. And if these are temporary accounts, the assets, liabilities, and equity are called real accounts or permanent accounts, and sometimes called the balance sheet accounts. So that's the end for this topic. Although there is still one thing that I'd like to emphasize before we go back to the journal entries, and that's up next. I told you earlier that the elements of the financial statements are the assets, liabilities, equity, revenue, and expenses. However, guys, these elements are very general in nature. Actually, there are a lot of specific types of assets, liabilities, revenue, and expenses. As to the equity or capital, let me repeat that again. If we separate the revenue and expenses temporarily, then there are only two transactions that will affect the equity account: the investment from owners and the withdrawals by the owners. The assets can actually be subdivided into two groups. So we have the current assets and we have the non-current assets. So let's define first the current assets. So this can be converted into cash, and if it is not converted into cash, the benefit from it can be fully utilized within 1 year. So examples of this is cash, so no need to explain that. We also have marketable securities, which are investments by the company that can easily be converted into cash. And we also have receivables, particularly accounts receivable from customers, which are recognized again when you have delivered already the services or goods, but the customers did not yet pay. Another example is the inventories, which are tangible goods that the business intends to sell in the ordinary course of business. We also have supplies, and unlike inventories, supplies are items that are not available for sale. Examples are bond paper that will be used in the office or the toilet paper that will be used in the office's bathroom. And we also have prepayments or advance payments like this prepaid rent. So that's it for current assets. We have another classification, the non-current assets, or known as long-term assets also. So if these current assets are those that can be converted into cash or that can be used within 1 year, these non-current assets are those assets whose benefits can be consumed for many years. So we have a lot of examples. We have the machinery, equipment, building, and of course land. So that's it for the assets. But before we go to liabilities, let's talk about the arrangements of these accounts. Actually, this arrangement is based on liquidity. What does this mean? It means the first to appear in the list are those accounts that are converted to cash faster and are used faster. That is why, as you can see here, the cash came first because you don't need to convert it already. Followed by marketable securities and accounts receivable because they are easily converted to cash when compared to inventory, supplies, and prepaid rent. I hope that's clear. Let me repeat that again. The faster the asset account is converted into cash or the faster it is consumed, the higher is its ranking on this list. That is why current assets comes first before the non-current assets because the current assets benefits are consumed faster. For example, supplies are consumed faster than the equipment, right? Another is that, as you can see here, the machinery, equipment, and building comes first before the land. It is because these three have a limited useful life, whereas the land, it has an unlimited useful life. So that's it for arrangement. Let's go now to liabilities. These are also classified as current and non-current liabilities. So let's have their simple definition. So we have current liabilities, which are liabilities that can be settled within 1 year, and non-current liabilities whose maturity dates are more than 1 year. So we have examples of current liability, and one of it is the accounts payable. This account is used when you purchase items on account from your suppliers. We also have unearned revenues or deferred revenues, which are actually your liability to your customer because they paid in advance before you deliver the goods and services. And we also have the salaries payable. In the non-current liabilities, we have loans payable and the mortgage payable. So to have an idea what is this mortgage payable, it is just the same with the loans. However, the creditor will ask for a collateral like a building owned by the business so that if the debtor can't pay, they can get the collateral and sell it in an auction, for example, to recover the amount lent. So these are the only two examples here, but actually there are a lot of liabilities that you will encounter when you reach higher accounting. Let's go now to equity or capital. As I've told you earlier, if you separate revenues and expenses, only investment and withdrawal of the owners will affect the account. That is why we have only two samples of account titles here. So we have the Igcasama capital, which will be used if the owners invests in the business, and the Igcasama withdrawal.
Next is revenues. There are a lot of revenue accounts, but before we go to the sample accounts, let's define first revenues. So these are increases in assets, but not because of borrowing funds or investment from owners. Examples are revenues earned from customers. When you earn revenues from customers, of course, your assets will increase, but not because of borrowing funds from, let's say, for example, bank or investment from owners, right? It can also be decreases in liabilities, but not because of payment of a debt. To understand that, let's have a situation. Example, you have a debt from someone, but that someone forgot about your payable, or that someone said to you to consider that his or her gift. Then it's your gain on your part because your liability was eliminated without paying, and gain is part of revenues. So that's what that means. So let's go to the specific examples of this account. We have service revenues if you are offering services to your customers, and we also have sales if you are offering tangible goods, and we also have gains. And again, those are just examples because there are a lot of revenue accounts, like for example, interest income or gain on sale of non-current assets, and many more. Lastly, we have expenses, which is the opposite of revenues. So these are decreases in assets, but not because of withdrawal of the owner or payment of liabilities. Best example is when the company pay for salaries of the employees. So in this particular transaction, the assets will be decreased, of course, but not because the owner withdrawn funds or the company paid its debts. It can also be increases in liabilities, but the company didn't borrow funds. Example situation is when your company was guilty of food poisoning of customers and you are to pay penalties in the near future. Here, the business incurred liability even without borrowing funds. So let's go now to the specific account titles. So we have salaries expense, utilities expense, commission expense, and miscellaneous expense. So that's it for the sample accounts. Sir, one last thing. If we are assigned to arrange account titles, do we really need to list first the asset accounts before the liabilities, and then equity, and then revenues before the expenses? Yes, you have to follow that. And remember, that pattern based on this ALERE cannot be interchanged. Actually, this list of account titles is already an example of a chart of accounts to a certain company. The only thing that is lacking right here are the account codes, which corresponds to the specific account. Let's say for example, 1-01-01 code corresponds to cash. Of course, the account code should have a meaning, like when I made the sample code, the first digit corresponds to what element of FS is the account. So 1 is for the assets, 2 is for the liabilities, 3 is for equity, 4 is for revenues, and 5 is for expenses. And since the cash is an asset, I used 1 right here. The second digit, the -01 here, this one pertains to current classification or non-current classification. And since cash is a current asset, then I used -01. Otherwise, if the account is non-current, then I will use -02. And the third set of numbers is based on the specific position of the account title. What I mean is, cash is the first on all the current asset, which is why I used -01 in this third set of numbers. So following the pattern, we can say that commission expense should have a code of 5-00-03. 5 is for the expenses. The next two digits is 00 because there are no current and non-current classification for expenses, and the last two digits is -03. It's because on all the expenses, it is the third expense. So actually, a company can list their own account titles and design their own account codes. Now maybe some of you are asking, what's the use of the chart of accounts, sir? Actually, when you record or make journal entries, the only account titles that you can use are those that are listed on the chart of accounts. That is why we have this topic. So that's it for this slide, but before we go back to the journal entries, a bonus topic is coming up next. Since we are already talking about accounts, I would like to introduce you to the contra accounts and the adjunct accounts. So let's have first the contra accounts. What are these? These are sub-accounts to a main account, however, the balance of these sub-accounts are deducted from the main account. To understand that further, let's have the examples, which are the allowance for doubtful accounts or the allowance for bad debts and the accumulated depreciation account. Let us focus first on the allowance for doubtful accounts. This is a contra account of the accounts receivable. I would like to emphasize though that it is not the same with the doubtful accounts expense. So let's elaborate. For example, you have an accounts receivable from your customers worth 100,000 and you doubt that 5% of it is uncollectible. I told you in the past video that the effect of this transaction on the A is equal to L+E is a decrease on the capital due to an expense and of course a decrease in asset. And actually, this expense is what do we call as the doubtful accounts expense or the bad debts expense. And this decrease in asset is a decrease in the accounts receivable. So incorporating what we have learned a while ago, we can have entries which is debit, doubtful accounts expense 5,000, the 5% of the total receivables. Why debit? Because the normal balance of an expense is debit, right? And take a look at the capital. It was decreased, right? And decrease in capital means debit. So I hope that's clear. Next is we credit the accounts receivable for 5,000 since it was decreased. So if we do that, then we will have a balance of accounts receivable of 95,000. That's 100,000 minus the 5,000 doubtful accounts. Sir, where is the allowance for doubtful accounts? Wait, we will get to there. Actually, there are two methods in recording the doubtful accounts expense. One method is the direct write-off method. That's what we did right here. So this is the direct write-off method where we deducted the doubtful accounts expense directly against the accounts receivable. We have another method which is the allowance method. In here we are still going to debit the doubtful accounts expense, but instead of using accounts receivable in the credit, we are to change this to allowance for doubtful accounts of 5,000. And then presentation in the financial statements will become, instead of accounts receivable 95,000, we're going to recognize accounts receivable at gross of 100,000, but we will deduct the contra asset allowance for doubtful accounts balance of 5,000 to get the net realizable value of 95,000. So that's it for the allowance for doubtful accounts. But before we go to the accumulated depreciation, if you are asked what is the normal balance of allowance for doubtful accounts, then your answer should be credit. Let's go to accumulated depreciation account. So this is a contra asset of depreciable assets like machinery, equipment, building, and etc. To understand further, we have an example. So you have an equipment worth 100,000 and it has a useful life of 10 years. So here, since there is no salvage value, 100,000 will become the depreciable amount immediately or automatically. Then you divide it by 10 years, so the depreciation is 10,000 per year. So I told you in the past video that the effect on the assets equals liabilities plus capital will be a decrease on the capital because of the depreciation expense, and of course it's a decrease also on the equipment, on the assets. So if we're going to have an entry, we're going to debit depreciation expense of 10,000 and we are supposed to credit equipment for 10,000. Unfortunately, there is no direct write-off here. Not the same with the direct write-off here in the allowance for doubtful accounts. So we cannot use the equipment account. Instead, we are going to use the accumulated depreciation dash equipment of 10,000. So in the presentation, we're going to present equipment at its gross of 100,000 and we are going to deduct the accumulated depreciation equipment balance of 10,000. Then we will have 90,000, which is what do we call as the book value of the equipment. I'll give you another bonus knowledge. So this account, the accumulated depreciation, is cumulative in nature. That means, based on this illustration, you have 10,000 in year 1. However, in year 2, it will become 20,000. And in year 3, it will become 30,000 and so on. So now, before we go to adjunct accounts, I would like to emphasize two things, and that is, number 1, allowance for doubtful accounts and the accumulated depreciation is very different from their expense counterparts, the doubtful accounts expense and the depreciation expense. And number 2, these are just two examples of contra accounts. Actually, there are a lot of contra accounts. So that's it. Let's go now to the adjunct accounts. So these accounts can still be considered as sub-accounts of a main account, just like the contra accounts. However, their balances adds to the balances of the main accounts. That is why this is called the opposite of contra accounts. Example is, when your company buy and sell goods. For example, you bought inventories for 100,000 and paid 3,000 for transporting the goods. The question is, how much will be capitalized as inventories? To answer that, we have of course the purchase cost of 100,000 and the freight in of 3,000. So all in all, the capitalizable cost is 103,000. By the way, freight in is an example of an adjunct account. And that's it for this slide. But before we go back to journalizing, I would like to tell you that you will encounter a lot of these accounts in the future. Now, let's go back. So, we are now back. So let's analyze again the transaction, of course, with the newly acquired knowledge a while ago. But before we do that, I told you earlier that this can be read as debit supplies, and then we have two credits, the accounts payable and the cash. So let's go back to the transaction. The transaction says supplies were purchased for 20,000, 10,000 was paid in cash, and the rest were paid after 2 months. So let's see if this is correct. Of course, the supplies is correct. It is to be debited because the supplies increased. And of course, the cash credit is also correct because the cash decreased because of the down payment. And the accounts payable increased because of the unpaid balance. So it is correct that it should be credited. As you can see here, there are 2 credits and 1 debit. So actually, this is what do we call as the complex entry. So if you are going to see only 1 debit and 1 credit, that is what do we call a simple entry. Actually, you can have a lot of debits and credits as long as the debit balances equal the credit balances. So like we have this one. So the debit is 20,000 and also the credit total 20,000 also. Guys, before we go further, I would like to tell you that the data for the transaction, like for example in this, we have 20,000, the amount of the supplies as well as the payment terms are found on the source documents. So what are these source documents? These are actually papers that are considered evidences that a transaction really happened. So examples of which are the purchase order, sales invoices, and official receipts from your supplier, for example. So that's it for the source documents. Now guys, I would like to tell you that this is not a complete journal entry. Actually, a complete journal entry includes a date, 3/15/XXXX, and of course, an explanation on the transaction, which is in here we have to record supplies purchased partially on account and the down payment per sales invoice 0050 dated 3/15 for excess. And aside from that, you are going to have a number sign if this is already the last transaction for the day. So that's it for journalizing. Of course, we will not end this particular video without a comprehensive illustration. So now let's apply. So we have here the illustrative problem. Actually, this illustrative problem is coming from the last video. Actually, there are 2 sets of transactions that were presented in the last video. The first one is this one, and the second one are the transactions for adjustment. So for this particular video, we are going to ignore the second set of transactions. And of course, we're going to add here the account list so that we can journalize. Aside from that, we are going to ignore some parts of a complete journal entry. Let's say for example, the date, as well as the explanation, as well as the number sign in order to maximize this space. With that, let's start. So in letter A, since the owner invested 100,000 to open the business, so the business received cash, so we are going to debit cash 100,000, and of course we're going to credit Gletz capital 100,000. Reminders again, you cannot use any account title which is not listed on this account list. So that particular reminder, it's because of transaction letter B. So you have paid business permits and licenses 2,300. In here, we do not have any expense account that is for business permits and licenses. But we know that it's an expense. So it's better to use miscellaneous expense 2,300 and credit cash 2,300. Next is letter C. So you have paid advance rent for 5 months. So what will you do? Of course, debit prepaid rent 15,000 and credit cash 15,000. Transaction letter D has already been answered and analyzed earlier. So we debit here supplies 20,000 and cash credit for the down payment, and the unpaid balance is credit accounts payable of 10,000. And of course, on letter E, since you have purchased a new asset, then we are going to debit office equipment 30,000, but we're going to credit cash 30,000 because we have sacrificed the cash. In letter F, when you are going to pay salaries, then you are going to debit salaries expense 30,000 and then credit cash 30,000. And in letter G, you've paid for utilities, so you debit utilities expense 19,750 and credit cash 19,750. In letter H, you have received advance payment from customers, so you're going to debit cash 80,000. However, you're not going to credit service revenues yet because you have not delivered any services or goods yet. So what are you going to credit? It's the unearned service revenues, which is a liability account. So unlike H, letter I, the clients paid 40,000, so debit cash 40,000 for services already rendered. So the credit is service revenues 40,000. And last but not the least, we have the last transaction. The owner withdrew 25,000 for personal purposes, so that's a credit to cash, and of course a debit to Gletz withdrawal. So that's it for this particular video. If you liked it and if it helped, then please click like and subscribe, and of course share this video to those who need it. And if you have questions, place it in the comment section below. So next is step 3 and step 4. Step 3 is posting the journal entries to the ledger or the T accounts. For that, we need the journal entries from the last video. So these are the journal entries. So what is a T account? The T account is just like this one, although we're going to add a horizontal line below. The account titles used by the company in their chart of accounts must each have a T account. For example, this T account right here is owned by the account title cash. So, the journal entries pertaining to the cash must be posted in this T account. But how do we do that? It's right here. Please focus on the amounts which are colored red because they are related to cash, right? So as you noticed, there are debit and credit entries. For example, this one right here says debit cash of 100,000. So how do we post this? You post it on the left side of the T account, because the left side is for the debits, and of course the opposite side, which is the right side, is for the credits, which is why this credit 23 in letter B, 15,000 in letter C, credit 10,000 in letter D will be posted here. So 23, 15,000, 10,000, and this 30,000, and another 30,000, and another 19,750. And then there is a debit of 80,000, so you put it on the left side, and another 40,000, and the last credit cash 25,000 will also be on the right side. So that's how you post. After posting all the entries related to cash, you need to total the amounts in the debits and the credits. So you can add all the debits, then you will get 220,000, and the credits will total 132,050 pesos. You need to get the difference of these two because remember, cash debits are for cash inflows and cash credits are decreases or disbursements of cash, right? So the difference is the cash balance, which is in this case, it's 87,950, and it is found on the debit side because here, the debit totals are greater than the credit totals. So that's how you post journal entries to the T account. And since there are still other account titles not yet posted like this miscellaneous expense and the prepaid rent and many others, you need to make a T account for each of them and it will look like this. And then post these amounts. Of course, you focus on the black colored ones because the red ones have already been posted here. And it will look like this. After that, we have to get the balances of the accounts just like what we did here in the cash account, and it will look like this. So as you can see, I have separated the accounts based on their normal balance. Actually, the assets, the withdrawal, and various expense accounts are here because they have debit as their normal balance. And of course, the capital, the liabilities, as well as the revenue accounts are here because their normal balance is credit. So why did I do that? It is because before you go to step 4, you need to be sure that all the debit balances like the balance of this cash, this withdrawal, and the various expenses is equal to the credit balances. So if you total this, you will have 230,000, and of course there will be no problem because the total credits is also 230,000. And that's it for this slide. But before we go to step 4, I'd like to emphasize two things, and that is coming right up next. The first that I would like to emphasize is the complete ledger, because the T account that I have introduced a while ago is not complete, meaning this is not enough. So you have to put other details like, for example, the date of the transaction. Example, this cash inflow or debit 100,000. When did this happen? The answer should be the date. So you should put the date here. For example, the date for this cash inflow is 1/8/20XX. Of course, other postings should also have their own corresponding dates. Another is that you must also add the transaction descriptions like this one. This cash inflow happened because of what? I don't know if you can still remember, but this happened because of the initial investment of the owner, right? And of course, this 2,315,000 and these credits happened because you have paid for business permits and licenses. You have also paid for advance rent, as well as you have purchased and partially paid the supplies. You also have purchased office equipment, and you paid for salaries of the employees, as well as you paid for utilities, and you have this 80,000 because the customers paid in advance, and another 40,000 because you receive cash from customers for the services you've already rendered. And the last credit of 25,000 happened because the owner withdrawn from the business. If you can still recall, the complete journal entry does not only include the debit and the credit and its amounts, right? There is also an explanation of transaction. That explanation and these descriptions right here must coincide. Now, let's go to the last additional detail, which is the reference. The reference answers the question where thus the posted amounts can be verified in the journal. For example, this posting of 100,000 is related to this journal entry, right? So what page can this journal entry be found in the general journal book? Because the journal entries are usually recorded in a general journal book. The answer to that is the reference. So this reference number in the example, this GJ-P1 is actually General Journal page 1. Of course, the other postings must also have their own references. So that's it for the complete ledger. The second that I would like to emphasize is more like an additional knowledge, and it is about subsidiary ledger. Subsidiary ledgers are the breakdown of a general ledger account. What does it mean? It would be easier if we go directly to the example. Example, you have an accounts receivable of 1 million because you sold your goods or services to customer A, B, and C on credit or on account. Logically, of course, collectible from each of your customers should be monitored individually, right? So how to do that? Of course, by opening a subsidiary ledger for each of them. We have, for example, AR from A, 400,000, B, which is worth 300,000, and C for another 300,000, which should total 1 million, which is also the total of the general ledger accounts receivable. That is why I told you that subsidiary ledgers are the breakdown of a general ledger account. Subsidiary ledgers can also be made for other accounts, like for example accounts payable and others. And that's it for the ledger. And by the way, the posting of these journal entries to the ledger is also technically known as classification of transactions, or simply classification. Let's go now to step 4, which is the preparation of the unadjusted trial balance. And let me tell you straight, this is just the listing of the account titles and their balances in the ledger, and it will look like this. If you remembered, in the T account discussion we had a while ago, we have a cash balance of 87,950, right? On the debit. And other debits for supplies of 20,000, prepaid rent of 15,000, office equipment of 30,000, Gletzmar withdrawal of 25,000, salaries expense of 30,000, utilities expense of 19,750, and miscellaneous expense of 2,300. On the credits, we have accounts payable of 10,000, unearned service revenues of 80,000, and Gletzmar capital of 100,000. We also have credit on the service revenues of 40,000. And if you noticed, accounts receivable, accumulated depreciation, and other accounts are still zero, since they were not yet used in these journal entries. But why was it included in here? It is because you need to consider all the account titles used by the company in their chart of accounts. And since in the last video, I included a list of account titles for our illustrative problem, so all of those that are included in there are also included in here. Don't worry, these unused accounts will be utilized in the next episode when we talk about adjustments. Let's go back to this one. To finish this, we need to total all the debits, and we're gonna get 230,000, which is also the balance of all the credits. Take note that the totals has a double underline, which we all call the double rule. So that's it for step 4. But before we end this video, I would like to introduce to you the worksheet, because actually the next step is the completion of worksheet. The 10-column worksheet, aside from the column of these account titles, is composed of the first and the second column is for the unadjusted trial balance. The third and the fourth column is for the adjustments. Column 5 and column 6 is for the adjusted trial balance. Column 7 and column 8 is for the income statement. And the last two columns is for the balance sheet. Other parts of the worksheet are the company's name in the center, as well as the word worksheet under it, and of course the date. To complete this, you just need to fill up the adjustments columns, and that would be on the next episode. So stay tuned. And if this helped, leave a thumbs up and subscribe. Welcome to the most challenging topic in the accounting process of service entities, which talks about the adjusting entries. Let's talk about first the 4 transactions that needs to be adjusted at year end. Number 1 is related to allowance for doubtful accounts. Number 2 is all about depreciation. Number 3 are the accruals, and lastly, the deferrals. Deferrals is a topic that most new accounting students find difficult, so I'll try my hardest to explain it well. So let's talk about allowance for doubtful accounts first. It is a fact that it is nearly impossible to collect 100% of your collectibles or receivables. That is why you need to estimate the doubtful for collection based on the historical or past experience of the company. And that is what we call allowance for doubtful accounts. We have an example here which states that 2% of your company's accounts receivable of 1.4 is estimated to be uncollectible. The entry for this one at year end is of course debit doubtful accounts expense of 28,000 and credit allowance for doubtful accounts 28,000, which is the 2% of the 1.4 million. The next is depreciation. In this slide, I have directly given the depreciation expense of 30,000. But what is this again? Depreciation expense is the decline of your non-current assets like building and etc. every period due to passage of time and wear and tear. The concept and computation of this depreciation as well as the doubtful accounts expense is explained in episode 2 and episode 3 of this series. You can check it out after this video. The link is on the description below. Anyways, the adjusting entry that you are going to make at the end of the year is depreciation expense debit 30,000 and accumulated depreciation 30,000. And that's it for depreciation. But before we go to the next, the accruals, let me emphasize that the adjustments that we're going to talk about in this video usually happens at the year end. Then we have the accruals. However, we have two types of accruals. We have the accrued revenues and accrued expenses. Accrued revenues are revenues earned but not yet collected. It means that the business has already delivered goods or services that it is supposed to deliver, but the client or customer did not yet pay. These types of transactions must be traced at year-end because they should already be considered as receivables and revenues based on the accrual concept, which is why in our example, which states that we billed customers for 100,000, we have this adjusting entry of debit, AR and credit service revenues of 100,000. The accrued expenses, on the other hand, are expenses that our company had incurred but not yet paid. Incurred means the company already used or exhausted the benefits without paying yet. In simple terms, in accrued revenues, the customers are late in paying. In accrued expenses, our company is late in paying. So we must also search for this type of transactions because they should already be considered as expenses as well as the liability of the company. So in our example, if we have unpaid salaries of 50,000, we are going to record it as debit salaries expense and credit salaries payable of 50,000. The last item are the deferrals. So there are two classifications of this. We have the deferred revenues, which are in simple terms, advance payment from customers, which is also the opposite of accrued revenues. Because when we say accrued revenues again, the customers are late in paying. And we have also the deferred expenses, which are also considered as prepayments or the advance payments of our company, which is also the opposite of accrued expenses. Because again, in accrued expenses, we are late in paying. So let's start with the deferred revenues. For example, a customer paid in advance 120,000 on 10/1/20XX for 12 months of your services. So that means your services are worth 10,000 per month. So year end is 12/31/20XX. Before we consider this example, I would like to emphasize that when we talk about deferrals, the initial recognition is very important to determine what is the appropriate adjusting entry at year end. What do I mean? Let's consider the example. The advance payment is on 10/1/20XX, right? So our entry for that date is debit cash 120,000 and credit unearned service revenues of 120,000 also. Again, unearned service revenue account is a liability account. That is our entry because technically we receive something that we don't deserve yet because we did not yet deliver goods or services. So I would like to make it clear that this is not the adjusting entry, but the adjusting entry will be based on this. But before we talk about the adjusting entry, we need to know the time between the advance payment and the year end. And in this example, we have 3 months or 3 months has passed. That means on the advance payment of 12 months, 3 months has already been earned. And if we convert it in money, that's 30,000, which is 10,000 per month times 3 months. So our liability or unearned service revenue at 12/31/20XX should only be 90,000. So the adjusting entry should be debit unearned service revenues of 30,000 to deduct our liability by 30,000 and credit service revenues of 30,000 because again, we already earned the 30,000. And in here, you'll see that if we didn't include the date of advance payment or initial recognition in our analysis, then we can't come up with the appropriate adjusting entry. Another reason for considering the advance payment date instead of considering only the year end is that there are two methods on how to record advance payment from customers or deferred revenues. So what we did here is called the liability method, where the advance payment is initially recorded as a liability or an earned service revenue, and the adjusting entry is focused on establishing what we have earned, the 30,000. The second method is called the revenue method, where at the initial recognition, the advance payment is recognized as service revenues immediately, even if the company did not yet perform services or delivered goods yet. So at 10/1/20XX, your entry will be debit cash 120,000 and then credit service revenues of 120,000. On the year end, the service revenue account should only have 30,000 balance since you only earned 3 months out of 12 months, right? So you should deduct the service revenues account by debiting it with 90,000 so that the service revenues that you initially recorded at 120,000 will become 30,000. And of course, you need to credit the unearned service revenues of 90,000 to establish your remaining liability for the unperformed services, which is 9 out of 12 months. As you can see, the adjusting entry here focused on the recording of the unearned portion. But even if these two methods are different in the initial recording and adjustments, the balances in the account titles used in these two methods are the same. Like for example, they both have debit 120,000 cash. And of course, when we talk about unearned service revenues, in the liability method, we credited first 120,000, but at the end, we debited 30,000, so the net balance of the unearned service revenues under the liability method is 90,000. Now, on the revenue method, the unearned service revenues is also 90,000. And lastly, the service revenues account under the liability method is 30,000. In the revenue method, we credited first the service revenues at 120,000, but later on, we have deducted 90,000 from it. So the net balance is still 30,000. In conclusion, both methods produce the same account balances. So, one last thing before we go to the deferred expenses. I would like to emphasize that revenue method is used by companies who are sure that they will earn advance payments from customers in a short period of time. For example, your company is sure to earn the advance payments in just 3 days. So, you need to debit cash and then credit revenues agad because it is inefficient to record the advance payment as liability or unearned service revenues first, and then after 3 days you're going to make another entry for adjustment, right? So that's it for deferred revenues. Let's go now to deferred expenses or prepayments or advance payments of our company. So we have our example here. Our company paid advance rent of 42,000 on 9/1/20XX for 6 months. So 42,000 divided by 6 months, meaning the rent per month is 7,000. Year end is still at 12/31/20XX. So I'll be straight. There are also two methods in accounting prepayments. We have the asset method, and of course we have also the expense method. In the asset method, the initial payment is accounted as an asset. So considering the example, on 9/1, our entry will be prepaid rent 42,000 and of course credit cash 42,000 also. At year end, before adjusting, you also need to count the time passed from 9/1 to 12/31, which is 4 months. So that means 4 out of 6 months, or in monetary terms, 7,000 times 4 months equals 28,000 was already used and must be expensed. So on the year end, you're going to debit rent expense 28,000 and credit prepaid rent of 28,000 also, so that will be able to reduce the prepaid rent from 42,000 because again 28,000 has already been used and must be expensed. So that's it for the asset method. But before we go to the expense method, I would like to summarize that when you are going to use the asset method, the prepayment of our company is recognized as an asset first, just like this one, and at the year end, the expense portion will be recognized. In the expense method, the payment is recognized as an expense immediately even if the company has not yet used the benefit of such payment. So on 9/1, the entry is debit rent expense for 42,000 and of course credit cash for 42,000. But in the year end, you need to credit the rent expense because its account balance should only be 28,000 because we only used 4 months out of 6 months of the advance payment. So to do that, we need to credit rent expense of 14,000, which is the monetary value of 2 out of 6 months, which is the unexpired or the unused portion of the advance rent. Of course, the debit is the prepaid rent for 14,000. So again, I would like you all to remember that if the company uses the expense method, then the advance payment is initially recorded as an expense immediately. And at the year end, as an adjustment, you need to focus on establishing the unused portion. So before we go to the short summary, I'd like to tell you 3 things. Number 1 is that supplies can also be accounted for using the asset or expense method. Number 2 is that expense method is used if the company is sure to consume the benefit from the advance payment immediately. Like for example, if your company buys supplies and your company is sure to consume all those in just a week. So if that happens, it is better to record it immediately as supplies expense instead of recording it as an asset first, but after a few days, you're going to record it again as a supplies expense. It is very inefficient. And that's it for this slide. Now, let's go to the summary. Again, there are items that needs to be adjusted at the year end. The first one is the recognition of the doubtful accounts expense. The adjusting entry of course is debit doubtful accounts expense and credit the allowance for doubtful accounts. Next is the depreciation. To adjust, you compute for the depreciation at the year end and record it as debit depreciation expense and credit accumulated depreciation. The next is the accrued revenues, and the adjusting entry is just simply debit receivables and credit revenues. And we have also the accrued expenses. The adjusting entry is debit expenses and then credit payable. And the highlights are the deferrals, and we have the deferred revenues, which can be accounted for using the liability method and the revenue method. So under the liability method, the advance payments of the customers are considered as liabilities at the payment date, but in the end of the year, the adjusting entry focuses on the earned portion. The deferred revenues can also be accounted for using the revenue method, where the advance payment is recognized initially in full as revenues, but at the end, you need to debit revenues and credit unearned revenues for the unearned portion. And lastly, we have the deferred expenses, which can be accounted for using the asset method and the expense methods. Under asset method, prepayments are recognized initially as assets, but at the year end, the expense or the expired portion will be recognized. On the other hand, under expense method, the advance payment will be expensed immediately, but at the year end, such expenses will be adjusted to recognize the unexpired portion or the unused portion. And if you ever get confused on deferrals, please remember the letter E for asset and liability method because their adjustments focuses on the earned portion for the deferred revenues and the expense or the expired portion when we talk about the deferred expenses. But if we're going to talk about revenue method and expense method, please remember the letter U because under the revenue method, the unearned portion is the focus for the adjustments, and under the deferred expenses under expense method, the adjustment focuses on the unused portion. So that's it for this video. I hope it helped, and if it did, please click like, subscribe, share, and hit the notification bell for more updates. And see you on the next episode. Welcome to video number 6. In the last video, we talked about adjusting entries, the accruals, deferrals, and bad debts, expense, as well as depreciation. But why do we need to know about those? Because we need to plot it right here, the third and the fourth columns of the worksheet. So in this episode, let's complete this worksheet by answering the illustrative problem that was introduced in the episode 2 of this series. Actually, this series of episodes are based on that one illustrative problem. So before we try and complete this, let's have the recap on all the episodes so far. Before we do this, please see all previous episodes first to maximize learning. Don't worry, because the episodes for this series are not lengthy. And remember this, for example, if you start at episode 1, at the end of the video, there will be a suggested video that will lead you directly to the next episode. So go and check it out. The links are on the description below. Now let's recap. On episode 1, we answered the question, what is accounting and what do accountants do? On episode 2, I introduced this illustrative problem, which will be used for this whole series. On episode 3, this first set of transactions have been journalized, and these are the journal entries, while this set of transactions have been ignored or was not yet tackled. On episode 4, these journal entries have been posted to the T accounts or the ledger, and it became like this. Also, on the same episode, the totals of this ledger or T accounts were organized in order to form the unadjusted trial balance, and this is the unadjusted trial balance. In this current episode, again, we need to fill up this third and fourth columns of the worksheet, and to do that, we need to consider the set that has been ignored again in episodes 3 and 4. These are the set of transactions. The first set of transactions was not ignored, that is why there are journal entries pertaining to this one already. So let's start with adjustment number 1, which states that rent for 2 months has already been used. So this is directly related to transaction C, where our company paid in advance for 5 months rent. That is why the initial entry is debit prepaid rent, which is 3,000 per month times 5 months, which is 15,000, and credit cash of 15,000. Since 2 months has already been used according to this, then the rent expense of 6,000 must be debited, and of course, we have to credit the prepaid rent also of 6,000. And as you can see, the company used the asset method since the advance payment was recognized initially as an asset. So naturally, on the year end, the adjustment focuses on the expired portion of the deferred asset. But what if the company used expense method? So if that's the case, the initial recognition will be rent expense 15,000 and credit cash 15,000, even if the benefit has not yet been consumed. However, as an adjustment, remember, only 2 months rent or 6,000 was actually consumed. So you need to deduct 9,000 from the rent expense. So we have to credit rent expense for 9,000 and debit prepaid rent for establishment of the unused portion. Number 2 adjustment is related to letter D, where the company purchased supplies of 20,000 partially on account. That is why the entry is debit supplies 20,000 and credit cash 10,000 for the down payment and payable 10,000. But in this, it is said that the remaining supplies is 3,500. So that means 16,500 worth of supplies was used. So at the year end, we need to debit supplies expense of 16,500 and credit supplies 16,500. But then again, in the last video, or episode 5 for adjustments, I emphasized that supplies is also a deferred asset, so it can also be accounted for using either asset method or expense method. What we did here is what do we call as the asset method. But if we use the expense method, the initial entry of course will become, instead of supplies expense of 20,000 and then credit the same cash 10,000 and accounts payable of 10,000. Now, in the year end, we are going to establish that only supplies of 16,500 was used. So the supplies expense should be credited by 3,500 to reflect the actually used of 16,500. And of course, we are going to establish the unused. So we're going to debit supplies worth 3,500. Adjustment 3 is related to transaction E here above, where office equipment was purchased for 30,000, which is why the entry is office equipment debit 30,000 and credit cash 30,000. And according to this number 3, the office equipment has a life of 5 years and a salvage value of 500. And as you can see, this equipment has already been used for 2 months. That is from November 1, 20x2 and December 31, 20x2. So that's 2 months. So which is why at the adjusting entry, we need to debit depreciation expense and accumulated depreciation office equipment as the credit. But the question is, how are we going to compute for the amount? So I have already discussed this in episode number 2, which is if you wanted to compute for the depreciation using the straight line method, you need to start with the cost. And the cost here is 30,000. After that, you need to deduct the salvage value. So we have 500. So the depreciable amount related to this problem is 29,500. After that, you need to divide it by the years of useful life, which is 5 years. So we're going to get the depreciation per year of 6,000. But since the office equipment has only been used for 2 months, you are going to multiply that with a fraction, which is 2 months over 12 months, and there you go, you're gonna get the amount 983.33, the depreciation expense for 2 months. You need to use that in this entry. So debit depreciation expense 983.33 and credit accumulated depreciation office equipment of the same amount. Number 4 and number 5 is not related to any transaction here, so let's consider them separately. So number 4 is an example of an accrued expense. So in here you have unpaid salaries of 3,000. The adjusting entry is simply debit salaries expense of 3,000 and credit salaries payable of 3,000. While number 5 is an example of accrued revenues, which the adjusting entry is just debit receivable and credit revenues. And in this case, since you billed customers for services for 5,000, so you just need to debit accounts receivable of 5,000 and then credit service revenues of 5,000. And the last number, the number 6, is directly related to transaction H, which is a deferred revenue because the customer paid in advance 80,000 for 5 months. So that means your services are worth 16,000 per month. In the date of the payment, which is December 1, the entry is debit cash 80,000 and credit unearned service revenues of 80,000. Unearned service revenue is a liability account. And why did we do that? Because if you are considering the deferred revenues and the problem is silent, the liability method will be used. But if we talk about deferred expenses, just like this prepaid rent as well as supplies, if the problem is silent, the asset method will be used. And you need to remember that. According to this, 1 month of advance payments or 16,000 was already earned. So unearned service revenues at the year end should be debited to reduce the account because again 16,000 was already earned, and of course service revenues account should be credited. But if we use the revenue method, we're still going to debit cash 80,000 but credit instead the unearned service revenue. We're going to credit the service revenues of 80,000. And on the adjustments, we should focus on the unearned portion, which is 4 out of 5 months, or in money terms 64,000, or 4 months times 16,000 per month. So you need to debit service revenues of 64,000 and credit unearned service revenues of 64,000. So that's it for adjustments. But what entries do we need to put in the worksheet? So we have this number 1, and then number 2, number 3, number 4, number 5, and number 6. So why is that again? Because we adopted on the deferrals, both on the deferred expenses and deferred revenue, the adjusting entries for the liability and asset method, because our illustrative problem is silent on the treatment of such deferrals. Now, let's complete the worksheet. So this is the worksheet with the unadjusted trial balance. Let's now post the adjusting entries. What are they again? I know you did not memorize all of those, so here they are. So now let's post. So debit rent expense, you post it right here. And also credit prepaid rent, you post it right here. Debit supplies expense 16,500, you post it right here. And then credit supplies right here. Depreciation expense 983.33 should be here. And the accumulated depreciation should also be here. The salaries expense should be debited here, and salaries payable should be credited also by 3,000. The accounts receivable debit 5,000, and then service revenue should also be credited by 5,000. And the last adjusting entry, we have an earned service revenue debit for 16,000 and service revenues for 16,000. So that's it for posting. But the third and fourth columns will never be complete if ever we are not going to add all the debits and all the credits. So the total for the debits is 47,483.33, while the credits is also 47,483.33. Now it's time to complete the rest of the worksheet. Let's fill up the fifth and the sixth columns for the adjusted trial balance. But how do we do that? You just have to summarize these four columns. Let's start with cash. So on the unadjusted trial balance, we have 87,950, and there are no entries in the cash in the adjustment. So you just need to copy this balance to the adjusted trial balance. So we have 87,950. On the accounts receivable, there is no balance in the unadjusted trial balance, but there is a debit entry on the adjustments. So you also need to copy that one to the adjusted trial balance. But in the supplies, the original entry is 20,000. However, in the adjustments column, there is a credit of 16,500. So in the adjusted trial balance, the supplies should be the difference between the two because they are opposite. This one is on the debit and this one is on the credit. Remember this. If in the unadjusted trial balance, the account title has a debit balance, but on the adjustments, there is a credit entry, or the other way around, which is if in the unadjusted trial balance, the account title has a credit balance, but in the adjustments column, there is a debit, then what will appear on the adjusted trial balance is the difference of the amounts, just like this supplies account. In the end, the supplies of only 3,500 will be registered on the adjusted trial balance. But if both the amounts in the unadjusted trial balance and in the adjustments has the same balance or the same normal balance, like for example, both are debits or both are credits, then you need to sum them up. So applying what we have learned, we have here the prepaid rent at 15,000 in the unadjusted trial balance, but we have 6,000 credit here on the adjustments, so we need to get their difference and put it right here on the adjusted trial balance, which is 9,000. We just need to copy the office equipment, which is 30,000, and we also need to copy this 983.33 for the accumulated depreciation here on the credit. We just need to copy also the accounts payable of 10,000, but on the unearned service revenues, we need to deduct the 16,000 debit adjustment with the 80,000 because again, they are opposite again. And we have 64,000 credit. And the salaries payable, we just need to copy this 3,000. And of course, we need to copy the capital as well as the withdrawal. So we have 100,000 credit and 25,000 debit. But on the service revenues, you have here 40,000 credit. On the adjustments, there are also 16,000 and 5,000 credit. So you need to add them up because both of them or all of these entries has the same credit balance. So we have 61,000. And we have the supplies expense. You just need to copy that, 16,500 here. And we have the salaries expense. We have 30,000, but in the adjustments, we have also a debit of 3,000. So we need to sum them up. So we have 33,000. The rent expense is 6,000. You just need to put it right here. And the 983.33 depreciation expense, you should also copy it here. So lastly, we have the utilities expense. we have 19,750 and 23. So the 5th and 6th columns will also never be complete if we're not going to get the totals of the debits and the totals of the credits, and they would be 238,983.33. Of course, the credit balance should also have the same balance. Now, let's complete the 7th and the 8th columns pertaining to the income statement, or what we call now the statement of comprehensive income. Here, you just have to copy the balances of the income statement accounts, or in simple terms, the revenue and expense accounts. To make it easier, I have put an asterisk symbol on the income statement account balances, so we just have to copy it from here to here, and it will look like this. Now, the next step is to add the debit and credit balances, but don't expect that it will have the same balances just like here, here, and here. Actually, if we're going to add all these debits, we will get 78,533.33, while the credits is only 61,000. So get the difference, which is 17,533.33, and add it in the lower amount, just like this one. So of course, after doing that, the debits and the credits will have the same balances. But what is the meaning of this, especially this amount? Actually, you know already that the expenses are on the debits, right? And of course, the revenues are on the credits, right? So this means, since the debits are greater than the credits, then that means there is a loss, which is 17,533.33. But if the credits or the revenues are greater on the other hand, of course, the difference of the two will become the income of the company. The last two columns is intended for the assets, liabilities, capital, and withdrawal account balances, or in simple terms, those balances of not income and expense accounts. And since the income and expense accounts right here has asterisk, then that means the balances with no asterisk shall be copied right here, and it will look like this. And of course, the same with the income statement. The balances for the debits and credits will not also balance, so don't expect that. Actually, the balance for the debits here is 160,450, while on the credit, we have 177,983.33, which is also off by 17,533.33. So you need to add that to the lower amount, and of course, they will both be balanced. Now, as you can see here, we added 17,533.33 on the debit, whereas on the income statement, we added the credit balances. So don't worry, it is supposed to be. When we are going to talk about the company incurring a loss, that means you need to expect that if the company, instead of a loss, will have an income, the adjustments will be on the debit of the income statement and the credit on the balance sheet. So that's it for this particular video for the completion of worksheet. If it helped, please do subscribe and hit the notification bell to be updated on my next videos. On the last episode, we completed this worksheet. Now, before we make the financial statements, I would like to add some things related to this. Number 1 is that the preparation of worksheet is optional. Number 2 is if the unadjusted trial balance, adjustments, or the adjusted trial balance columns is not balanced, instead of directly checking every single journal entry that you have made, which is so much hard work, you can do the following first. Get the difference of debits and credits first, and then divide the difference with 9. If the quotient is a whole number, like for example, the difference of debits and credits is 9,000. If we divide it by 9, the quotient is 1,000, and there are no decimals. If that's the case, the error might be a slide or a transposition error. But what are those? Slide is an error with decimal places. For example, you posted an amount of 10,500 instead of 105,000. Or you posted 13,551 instead of 1,355.1. While an example of transposition is when you posted 109,000 instead of 190,000. In these two types of errors, if you try to get the difference between the correct amounts with the wrong amounts posted, like this 10,500 and 105,000, and if you divide their difference with 9, you're going to get a whole number. Let's try. So the difference between these two, 10,500 and 105,000, is 94,500, right? So that 94,500 divided by 9 is 10,500. No decimals. So you are welcome to try the other examples mentioned. Sir, but what if the quotient after dividing it with 9 resulted to a quotient with decimals? Then you have no choice but to go to your entries in the journal and ledger individually. And remember, even if you balance the debits and credits for the unadjusted, adjustments, and the adjusted trial balance, it does not necessarily mean that you got the correct answer. And that's it for worksheet. So now, let's go to the preparation of the first financial statement. The first financial statement is the income statement, but today it is known as the statement of comprehensive income. What's the use of this? Actually, this helps the readers of FS to know if the company is performing well, because the income statement is where the profits and losses are detailed and computed. So I have here a portion of worksheet which only includes the account titles and the last 4 columns of the worksheet because they will act as a guide in the preparation of the financial statements. So as you can see here, we have the red colored funds which pertain to the income statement. So these details, you just have to rearrange that in a document format. So you can start with the heading, which consists of the company's name followed by the title of the financial statement. In this case, we have the statement of comprehensive income and the period covered. After that, extract the details from here. So let's start with the service revenues, which has a balance of 61,000. So you put it right here, and then followed by all of these expenses from the supplies expense up to the miscellaneous expense. Let's copy them, but never forget their balances. So we have here their balances, and then you total the expenses and you will get 78,533.33. You deduct the expenses from the revenues, and then you will have a loss of 17,533.33 because again the expenses are greater. So that's it for the income statement. The second FS is coming right next. The second FS is the statement of changes in owner's equity. So this FS just summarizes all the things that affect the equity or capital account. As I've told you over and over in the past videos, the 4 transactions that affect the capital or equity account are: number 1, the investments of the owner; number 2, the withdrawals of the owners; number 3 is the income or revenues of the entity; and the last are expenses of the business. Now, let's make the statement of changes in equity. But first, we need to have the income statement earlier because it will be used in making the statement of changes in equity. So here it is. So in making the statement of changes in equity, you need to start in the heading, which is the same with the income statement. It is composed of the company's name, the name of the financial statement or title of the financial statement, and the period covered. Next is we get the capital beginning balance, or in simple terms, the equity balance of the entity in the last period. And since our sample illustration talks about a newly formed entity, then our capital beginning is 0. So you can add 2 things. One is the investments from the owner, in which we have 100,000 according to our illustration, and the second one that we can add is the net income. Unfortunately, we don't have that because the entity according to here suffered a loss. So let's get the total, and we will have 100,000. So there are also 2 items that you can deduct, which are the withdrawals as well as the net loss. So according to our problem, we have withdrawals of 25,000, so we put it right here, and we have the losses of 17,533.33. You deduct these 2 from this 100,000, and we're gonna get the Gletz capital ending of 57,466.67, which is already the summary of investments and the withdrawals by the owner and the income and expenses of the business. So that's it for the statement of changes in equity. But before we go to the next, please remember this ending balance because it will be used on the third type of FS. The third FS is the balance sheet, but today it is known as the statement of financial position. So we have here again a portion of the worksheet, but now let's focus on the green colored fonts because these are the ones that we need to extract in order to make a balance sheet. So in making that type of FS, we need to make a heading which is also composed of the company name, the title of the FS, and the period ended. After that, let's start extracting information from here. So let's start with assets. However, we will start with the current assets first, or those assets that can be converted into cash or used by the entity in less than a year in simple terms. So by the way, for your information, I have already discussed the current and non-current classification as well as the contra and adjunct accounts in the episode 3 of this series, so you might want to check it out. Anyways, in here, we have the cash, we have the accounts receivable, supplies, and prepaid rent. So let's copy that as well as their balances. And after that, let's add this and we will have the 105,450 as the total current assets. Next is we have the non-current assets. In here, we only have the office equipment with a historical cost of 30,000. But since there is an accumulated depreciation balance of 983.33, then we need to deduct that one in order to get the book value of 29,016 pesos 0.67. So we have to add this 105,450 and 29,016.67 in order to get the total assets of 134,466.67. After that, we have the liabilities and equity. Now we will start with the liabilities, and we will start with the current liabilities, or in simple terms, the short-term liabilities. So we have here the accounts payable, the unearned service revenues, and the salaries payable in the amount of 10,000, 64,000, and 3,000. We have to copy those, and we need to get their sum. Their sum is 77,000. Unfortunately though, in our illustrative problem, we don't have any mention of any non-current liabilities, so we put on the non-current liabilities 0. So that means our total liabilities is 77,000 also. And lastly, we have the equity. The equity that we are going to put here is not from here, but instead, it's the equity balance end in the statement of changes in equity as discussed earlier. And if you can remember, that's 57,466.67. Now, we are going to add this total liabilities with the capital ending, and we will get 134,466.67 also. The same with the balance on the assets, because again, A should always be equal to L plus C. So that's it. But before we go to the next FS, I would like to tell you that there are two formats in the statement of financial position. What we used here is what do we call as report format, where we just listed assets followed by the liabilities and followed by the equity in a vertical format. We have another format where the assets are listed on the left while the liabilities and equity are placed on the right side. And that's it for the balance sheet. We have the statement of cash flows, which explains how the cash ending balance is produced. Logically, the answer is easy. The cash ending is produced by cash beginning or cash from previous year plus cash inflows minus cash outflows during the year. And for that, you can go to the ledger or T account of cash directly. So I have an example right here which was extracted from a past video in this lecture series. So here on the debits are the cash inflows, right? And here on the credit are the cash outflows. However, to make a cash flow statement, you need to further classify the inflows or outflows into three. These three are cash inflows or outflows from operating activities. We have investing activities, and the last is cash inflows or outflows from financing activities. Cash flows from operating activities are those cash flows and outflows related to the normal course of business of the entity. Examples are inflows from customers, or outflows to suppliers, or outflows due to payment of salaries of the employees. While cash flows from investing activities are those that are related to buying of long-term assets, machinery, or land or equipment, or when the entity invests to earn but such investment is not in any way related to the ordinary course of business. Like for example, buying of shares of stock of other companies to earn dividends, even though the company is not normally engaged in the buy and sell of shares, or letting others borrow money even if the entity is not engaged in financing in order to earn interest. There is a twist though. What is it? When the investment starts paying off, of course, the entity will receive interest and dividends. Those receipts will be generally classified as inflows from operating activities despite being a result of investing activities. So that's the twist, and you need to remember that. Now let's go to this. So inflows and outflows from financing activities are cash inflows and outflows from getting funds to start or expand the business. Examples are investments and withdrawals by the owner, or getting or paying a long-term loan for expansion. So if the entity is a corporation, proceeds from selling the shares are considered inflows from financing activities because they are considered as investments from owners. However, there is also a twist. When you get financing, eventually you will pay interest and dividends to the providers of funds. So there is no problem with dividends paid because they are considered outflows under financing activities as they should be. The problem is on the interest payments because they are considered outflows from operating activities despite being directly related to financing activities. And that's another thing that you need to remember. So before you forget, I will summarize the twists. Number 1 is dividends and interest received by the entity are inflows from operating activities despite being a result of investing activities. And number 2, the interest paid despite of being a result of financing activities is considered an outflow from operating activities. Now, let's apply what we have learned on this particular T account. What do you mean, sir? Let's try this one. It is said that this inflow is a result of investment from the owner, so this is clearly related to financing activities. So how about this? Payment for business permits and licenses is clearly an outflow from operating activities, as well as this payment of rent and the down payment for supplies, right? So let's put it right here. However, this payment of 30,000 for the purchase of office equipment, since this is an outflow for acquiring a long-term asset, then it is considered an outflow from investing activities, right? So the payment for salaries and the utilities, as well as the payments of customers or receipts from customers, are related to operating activities, right? So lastly, we have this 25,000, which is a withdrawal from the owner. This is an outflow related to financing activities. Now let us prepare a cash flow statement from this. So we should have the heading, and then we should have to start from the cash flow from operating activities, specifically the inflows. According to this, we only have two inflows related to operating activities, and these are the payments from customers, which are 80,000 and 40,000. Let's add these two and we will get 120,000. And then as to outflows, we have payments for business permits, payment for rent, payment for supplies, payment for salaries, and payment for utilities. Now we need to total them and we will get 77,050. We need to deduct the 77,050 from the 120,000, then we're going to get a net inflow of 42,950 from the operating activities. Cash flows from investing activities and financing activities are actually following the same pattern, as this will start with the inflows. But since we don't have any inflows in the investing activities, so we put here 0. However, we have one outflow related to the purchase of the office equipment, which we have an outflow of 30,000. So we need to add these two and we will get negative 30,000 in the investing activities. In the financing activities, we have one cash inflow pertaining to the investment of the owner worth 100,000 and an outflow of 25,000 from the withdrawal of the owner. So we have a net cash inflow from financing activities of 75,000. So if you total this, 42,950 plus negative 30,000 plus 75,000, you will get the cash ending balance of 87,950. Actually, aside from these three, the cash balance beginning or cash from previous years should be considered also. However, in our illustrative problem, the business that we have is just starting, so the cash beginning, which is 0, is ignored. So that's how you make the cash flow statement. But let me emphasize that what I taught you is just the basics of cash flow statement. In my next videos, I will teach you how to make a cash flow statement using direct and indirect methods. And that's it for this particular slide. But we are not yet finished. We still have one thing to talk about, and that's up next. The last thing that I'm going to emphasize is the notes and disclosures. Actually, if you're going to make a set of financial statements, we can have the page 1 for the income statement. The next page could be the statement of changes of equity, followed by the balance sheet, and followed by the cash flow statement. But the last should be the disclosures, which is composed of a lot of pages. Why? Because this includes a lot of things, like for example, information about the entity, like who are the owners of the business, or the principal location of the business, or the registration numbers of the business issued by many government regulatory bodies, and the details about their permits and licenses. It can also include a brief history of the business. Why? Because actually guys, these details of information are very important to know if the business or the entity is legit and existing. So it also contains the different accounting policies used by the business. For example, what is the depreciation method adopted by the company? Is it the straight line method or other methods? Because there are a lot of methods on estimating and computing depreciation. You will know more about these methods and the different accounting policies on my next videos. The notes and disclosures also includes the most important information, which is the breakdown of the account balances used in the 4 financial statements mentioned and discussed earlier. So we have an example right here. The accounts receivable of the entity is composed of receivables from A and B for 2,000 and 2,500. Other receivables are 500. So all in all, the entity has a receivables of 5,000. So you can also do this breakdown with cash, like for example, cash in bank per bank account, or you can do this also to payables to different suppliers. And lastly, there are other disclosures required, which will be detailed on my next videos, so stay tuned. And that's it for this video lecture. Please click like, subscribe, and share this video. If you have questions, you can comment it in the comment section. Thank you for watching. Welcome to step 7 to 10 of the accounting process. So this is already the episode 8 of this particular series. So if you did not yet see the previous episodes, please go to the description because their links are found there. Don't worry, because the episodes are short, and if you ever decide to see, for example, episode 1, at the end of that video, there will be a suggested video that will lead you directly to the next episode. So if you are through with the previous episodes, then let's get started. Let's start this video lecture with step 7, which is the adjustments are journalized and posted. But before that, I would like to emphasize that these steps that we are to talk about will directly be applied on the only illustrative problem considered in this whole set of series. So this problem was introduced way before. I think it's on the episode 2 of this series. Anyway, this step 7 is easy. Why? Because we already have the adjustments. So they have been prepared in the completing the worksheet episode of this series, or episode 6 if I'm not mistaken. To help you remember, these are those adjusting entries. So the only thing left to do is that we should post this on the ledger or T accounts. So in completing the ledger episode or episode 4 of this series, we have this particular T accounts. Now, what we need to do is just to post this to here. And to make that happen, let's rearrange this a little bit into this one. Now, let's post. So we have here debit rent expense of 6,000, but since we don't have any T account yet for the rent expense, so let's make one. So we have here the rent expense, and of course we need to debit 6,000, and we need to get the total of 6,000 also, because there are no other entries related to rent expense. But don't forget the credit prepaid rent. So we need to credit 6,000 here. So what will happen is the total of the prepaid rent from 15,000 will only become 9,000. Next is we have the debit supplies expense 16,500 and credit supplies of 16,500. But since we don't have any T account for supplies expense, so let's make one. So we have here the supplies expense 16,500 and the total is 16,500. And don't forget the credit supplies of 16,500. So we have here the supplies already. So you just need to credit the 16,500 and the 20,000, the previous balance minus the credit of 16,500, the supplies is now 3,500. And of course we have the third one, the depreciation expense and the accumulated depreciation. Both has no T accounts yet, so let's make one for each of these. So we have the depreciation expense here and the accumulated depreciation here. The fourth adjusting entry is salaries expense 3,000 and salaries payable 3,000. Luckily we already have a T account for the salaries expense. We have here the 30,000. So we're going to add the 3,000 right here and it will become 33,000. The problem is we don't have any T account for salaries payable. So let's make one. And the balance will be 3,000 credit. The fifth adjusting entry is debit accounts receivable. So there is no T account yet. So let's prepare one. So we have debit 5,000 and credit service revenues of 5,000. So we have here the service revenues already. We just have to add the 5,000. And lastly, we have debit unearned service revenues of 16,000 and credit service revenue 16,000. So we have both these accounts already. So we have unearned service revenues. So we have just to debit the 16,000 and it will become 64,000, which is 80 minus 16, and credit service revenues of 16,000. We put it right here, and because of this, the updated balance of the service revenues will now be 61,000. And that's it for posting adjusting entries. Now some of you will ask, what is the effect of the journalizing and posting of the adjustments? Well, to answer that, let's have the adjusted trial balance of the worksheet. So we have here the worksheet, the fifth and the sixth columns of the worksheet specifically. Now, observe the balances here in the adjusted trial balance and compare it with the balances here. It coincides, right? Like for example, we have a cash here of 87,950. We also have 87,950. The prepaid rent is 9,000 here and it's also 9,000 here. So that's the effect of the step 7. Actually, before we posted these entries to the T accounts, the balances of the T accounts before coincide with the balances of the unadjusted trial balance. But after these have been posted, the balances of the ledger became the balances of the adjusted trial balance. So that's the effect again of step 7, which is journalizing and posting the adjustments. Now, let's go to step 8. Step 8 is closing entries are journalized and posted. But before we go to the closing entries, let me tell you that there are actually 3 types of journal entries that you need to master in the accounting cycle or accounting process. So the first one, we have the journal entries from regular transactions. So we have our example right here, and these entries were extracted from the episode 3 of this series, which talked about posting journal entries to the ledger. The second set of entries, which you are familiar with, are the adjusting journal entries, which we have posted to the ledger a while ago in step 7. And the third set is the closing entries, which is composed of 4 entries. The first entry aims to close the income statement accounts with debit balances, or in simple terms, this closes the expenses of the company. But how do we close it? Since the expenses is a debit balance, We can close it or make it zero by crediting all of those expenses with a corresponding debit on the income summary account, which is a new account title again. To visualize that, let's apply it to our illustrative problem. So we have here the income statement from the previous episode. So let's get these expenses of the company. We have here the supplies expense, the salaries expense, the rent expense, depreciation expense, utilities expense, and miscellaneous expense. Let's credit all of them, and the total of this one will be debited in the income summary account, and the total is 78,533.33. So this is what the first closing entry looks like. The second entry is the opposite of the first entry. The second entry aims to close the income statement accounts with credit balances. And in our illustrative problem, we only have one account, which is the service revenue account. To close it, we are going to debit the service revenues of 61,000 with a corresponding credit to the income summary account of 61,000 also. So that's it. But before we go to the third closing entry, let's get the running balance of the income summary account. So here we have 78,533.33 debit, but we have a credit here of 61,000. So the difference is 17,533.33 debit. So is this familiar? Yes, of course. So this is the net loss right here, right? So if we analyze, the first and the second closing entries just summarizes the expenses and the revenues in one amount, which is the net income or the net loss of the company. And that net income or net loss of the company can be seen on the balance of the income summary account. The third closing entry is the closing of the income summary account balance to the capital account of the company. So in our illustrative example, we have again a debit of 17,533.33 in the income summary. So to close it and to make it zero, we have to credit the account for the same amount with a corresponding debit to the Gletzmar capital for 17,533.33. And that's the third closing entry. And the fourth closing entry is focused on the closing of the withdrawal account. And since in our problem, the owner withdrawn 25,000 for personal expenses, I hope you can still remember, so there is a debit balance of Gletzmar withdrawal for 25,000. So to close it, we need to credit it, and we have to debit the Gletzmar capital for 25,000. And that's it for the four closing entries. Others of you might ask about what is the purpose of the closing entries as a whole. So to answer that, the objective of these four closing entries is to close the expenses, revenues, and withdrawal accounts to the Gletzmar capital account, which is similar to what happened on the statement of changes in equity that we have made in the past episode. Actually, after considering these closing entries, the capital account balance or the Gletzmar capital here in our example will have a balance of this one, 57,466.67. But you can check that out later. So again, these are the four closing entries. But we are not yet through. We still need to post this to the ledger, and that's up next. So now we are on the posting of the closing entries, these closing journal entries to this particular ledger. Now let's start with the income summary. Debit 78,533.33. And since there is no T account for the income summary account title, then we need to make one. And there you go, we have the debit 78,533.33. Now we need to close the accounts like supplies expense. We have to credit 16,500 and it will be closed, and followed by the salaries expense, credit 33,000 and it will also be closed or become zero, followed by again the rent expense, credit 6,000 and it will be reduced to zero. We have also the depreciation expense, we're going to reduce that also to zero, and the utilities expense, credit 19,750, so it will become zero also. And lastly, the miscellaneous expense. Now, let's go to the second set of closing journal entries, which service revenues debit 61,000. Now, the service revenues will have a zero balance, and credit the income summary by 61,000. But before we go to the third, the income summary again, after the two closing entries, will have a balance of 17,533.33 on the debit. Now let's go to the third closing journal entry. So debit, Gletz Capital, 17,533.33, and credit the income summary. And if you credit that, then the income summary will have a zero balance already. And lastly, we have the fourth, which is we're going to close the withdrawal account to the owner's equity account. So debit Gletz Capital 25,000, put it right here, and of course the Gletz Capital will now have a balance of 57,466.67, which is the same with the equity balance in our statement of changes in equity that was prepared in the previous episode, as I've told you. Now let's credit the Gletz withdrawal 25,000, and it will become zero. So that's it for posting the closing journal entries, and that's it for the step 8. Step 9 is coming up next. Step 9 is the preparation of the post-closing trial balance, which is just a listing of these updated balances. So to make it easier, we should eliminate those account titles with zero balances. So here you go. Now let's make the post-closing trial balance. So let's start with the company name followed by the word post-closing trial balance and the date covered. So let's start with cash. So the cash is 87,950, followed by the accounts receivable of 5,000, and then we have prepaid rent of 9,000, and then we have the supplies of 3,500, and also we have the office equipment of 30,000. However, there is an accumulated depreciation, so let's put it on the credit, 983.33, and those are the assets. Let's go to liabilities. We have the accounts payable of 10,000. We have also the unearned service revenues of 64,000, and we also have the salaries payable of 3,000. And lastly, we have the Gletz Capital. The Gletz Capital is 57,466.67. So that's it for the post-closing trial balance. However, we need to total the debits and the credits to end the post-closing trial balance. So we have 135,450, both the debits and the credits. So that's it for step 9. Let's go to the last step, which is all about the reversing entries. So to be direct, let's answer the question, what journal entries are to be reversed? And the answer is the adjusting entries, but not all of them. But before we go to that, here is a slide from a previous video of this series which shows the items to be adjusted and the adjusting entries. So these red colored fonts are the adjustments or the adjusting entries. So which of these entries should be reversed? So let's start with the doubtful accounts expense. So the doubtful accounts expense should have no reversing entry or should not be reversed, as well as the depreciation. However, if we're talking about accruals, both the accrued expense and the accrued revenues must be reversed. But how do we do that? Let's just debit what was credited in here and credit what was debited in here. So it looks like this one. Sir, how about the deferrals? To cut the story short, the adjustment for deferrals under the revenue method and the expense methods are the only ones that will be reversed, and it will look like this. So, adjustments under the asset method and the liability methods shall not be reversed. Now, let's answer the question, when will you prepare the reversing entries? Reversing entries are prepared at the beginning of the next year. And that's it for step 10. However, some of you might be wondering, why do we need to make reversing entries? To answer that, let's have an illustration. And by the way, before we start, I have to tell you that preparation of reversing entries is optional. Now, let's have the illustration. This particular illustration is related to an accrued salaries expense. We have ABC company pay salaries of 50,000 per 15 days every number 1, 20th of the month for services rendered by the employees on the 1st to 15th of every month. And the second payday is every 5th of the next month for the services rendered by the employees on the 16th to 30th or 16th to 31st of the month. Of course, the salaries of 50,000 for December 16 to 31 20x2 shall be accrued by the company on 20x2 or at year end. But since it will only be paid on January 5 20x3, which is the next year, then this will be a very good example for the use or the logic for reversing entries. Now, let's make the entries first under the assumption of without reversing entries. So since the expense was incurred on December 16 to 31, there will be an adjusting entry for the accrued expense, which is salaries expense debit 50,000 and credit 50,000 salaries payable on December 31 20x2. On January 1 20x3, there will be no entry because the assumption again is that there will be no reversing entry. So the entry on January 5 20x3 should be debit salaries payable 50,000 and credit cash 50,000. The problem with this one is this: as an accountant, I would like to make only one type of entry when paying for expenses, and that is debit expenses, credit cash. As you noticed, that didn't happen here in January 5 20x3 because the entry is debit payable. Now, what if you forgot that there is actually a payable from last year? In the real world, there are a lot of accrued expenses every year end, and because of that, you tend to forget and will likely make the default entry of debiting expense and crediting cash, which will make your entry wrong. In this case, if you forgot, instead of debiting salaries payable, you will debit salaries expense at 50,000. And if you think about it, there will be two entries of salaries expense 50,000 already. One is from 20x2 and one from here, which is wrong, which is why I prefer to have a reversing entry. Now, let's check why. Let's assume the same problem but this time with the reversing entry. So on December 31 20x2, we will have the same entry with this one. However, on January 1 20x3, we are going to reverse it. So we have debit salaries payable 50,000 and credit salaries expense 50,000. And here's the beauty of it. On January 5 20x3, you can have the standard entry without thinking about the payable in the last year. So you can debit salaries expense 50,000 and then credit cash for 50,000 also. And it would still be correct. Why? As you can see, the salaries expense should be recorded in 20x2, right? Because it was incurred in 20x2, which we did. And even if we debited salaries expense on January 5, 20x3, it is still correct. Why? Because it has been negated by your reversing entry. So your debit here has been negated by this credit right here. So that's the logic and the usefulness of preparing reversing entries. So this is the end for this video lecture. Please click like, subscribe, and hit the notification bell for more updates. Thank you.